to This Explainer. Today, we're bringing you a very special Iron Financial edition. I'm your lead analyst, and my entire mission here is to help you forge a stronger portfolio and cut straight through the market weakness by looking strictly at the cold, hard data. Today, we are putting BP under the microscope. We're looking at their first quarter 2026 financial results, and let me tell you right out of the gate, the numbers we are seeing here are practically forged in the fires of extreme global volatility. Now, you might be asking, why does BP matter so much right now? Well, it's because this company sits at the exact intersection of critical global energy needs and absolutely unprecedented geopolitical chaos. For any investor, this is the ultimate stress test for your portfolio.
And I'm the market skeptic. I'm here to represent you, the retail investor. Because look, when I see massive headlines and soaring corporate profits during times of intense global crisis, my immediate question is always exactly the same. Is this genuine structural strength, or is it just temporary hype? Today, we're going to stress test BP's earnings report. We need to see if this company is built on a solid, ironclad foundation, or if there are severe cracks in the armor that those big, flashy headline numbers are actively hiding from us.
Exactly. So let's grab the heavy machinery and dive into this. We're going to completely unpack the balance sheet, the operational reliability, the geopolitical shockwaves, and the real heavy lifting happening beneath the surface. Let's get straight to the top-line number that literally has all of Wall Street buzzing right now. $3.2 billion. That is BP's underlying replacement cost profit for the first quarter of 2026. This isn't just a slight earnings beat, this is a massive structural display of financial horsepower. Now, to put that number into perspective for a second, the reported profit, the one attributable to shareholders, was actually higher. It was $3.8 billion. But we don't look at inflated surface-level numbers here at Iron Financial. When we strip out the inventory holding gains, which just means the paper profits they made simply because the oil they already had sitting in storage happened to go up in value, and when we remove all the adjusting items, we are looking for the true, naked operational strength of the underlying business. That's exactly what underlying replacement cost profit means. It ensures we aren't being fooled by accounting illusions, and that stripped-down metric lands at a rock-solid $3.2 billion. Speaking purely as an analyst, when I see a top-line revenue result like this, completely stripped of the fluff, it tells me their profit engine is firing on absolutely all cylinders. Okay, hold on just a second. Before we start celebrating that $3.2 billion figure as pure financial horsepower, we really need to look at the immediate public and political backlash surrounding it. You can't just look at a spreadsheet in a vacuum. We have Greenpeace UK stating on the record, and I quote, BP's profits are booming, with Trump's bombs bringing billions for them and bigger bills for us. Campaigners are loudly pointing out that these profits are coming at the direct expense of everyday consumers. Just think about the stark contrast here for a minute. You have a corporate profit engine churning out over $3 billion in a single 90-day window, while average consumers are facing energy bills that are pushing £2,000 a year. The public tension is immense. So my question for you as the analyst is whether this profitability is actually sustainable. If regulators or politicians suddenly decide to step in because of this massive public pressure, could this stock just collapse? Is BP just riding a temporary wartime hype cycle that's going to evaporate the very second geopolitics stabilize? All right, let's get into Section 1, the drill down, the profit engine. That sustainability question is exactly what we need to figure out today. So let's examine the concrete mechanics of how BP actually generated this massive pile of cash. We need to see if the core business is truly growing or if it's just a macro illusion, like you said. Notice the massive jump from Q1 2025, where BP reported an underlying replacement cost profit of $1.38 billion. Fast forward exactly 1 year, and that number has exploded to $3.2 billion. They have more than doubled their profits. Now, ask yourself, how does a massive, slow-moving, heavy industry giant double its profits in just 12 months? Well, the data shows this was driven heavily by their customers and products segment, which saw its underlying result jump from $677 million last year to a staggering $3.2 billion this quarter. BP explicitly credits an exceptional oil trading contribution and a stronger midstream performance. But what does that actually mean in reality? It means their traders capitalized perfectly on the extreme market volatility. They didn't just passively sell oil, they optimized supply across their entire integrated value chain, aggressively routing physical barrels of crude to specific global regions that were experiencing sudden, localized price spikes. They basically played the chaos perfectly. But listen, it wasn't just a bunch of traders sitting at desks staring at screens. There was serious operational heavy lifting going on to actually support those trades. Look at these reliability metrics. Upstream plant reliability improved to 95.7%, which is up from the previous quarter. Even more impressive, their refining availability hit 96.3%, successfully beating their own internal target of 96%. They achieved higher refinery throughput primarily because of lower turnaround activity and successfully recovering capacity at their massive Whiting refinery. Achieving a 96.3% availability in heavy industry is incredibly difficult. It literally means the actual steel in the ground, the physical infrastructure spanning the globe, was operating with immense durability and efficiency, keeping production perfectly steady despite some major global supply chain disruptions.
Look, I see the steel in the ground is holding up right now, but as an investor, I have to ask the obvious question. If you are running your refineries this hot, at over 96% capacity, doesn't that inherently increase the risk of future operational breakdowns? Pushing legacy infrastructure to the absolute limit usually means heavier maintenance bills down the road. But even beyond the physical wear and tear, I really demand some context on the broader environment here.
Let's move to Section 2, the drill down. Geopolitical fire.
Because let's be real, those massive profit margins don't just magically double because a refinery is running a fraction of a percent better. We have to look directly at the macro environment and the geopolitical fires that are acting as a massive tailwind for this stock right now. Let's check the timeline, because this is the real reason that $3.2 billion number exists. On March 1st, the US-Israel war on Iran began. This immediately triggered what the International Energy Agency called the greatest supply crisis in history. And why? Because Iran throttled exports of oil and gas from the Gulf by seizing control of the Strait of Hormuz. We are talking about a global choke point where roughly 20% of the world's global oil supply moves. Squeezing that bottleneck is obviously going to send massive shockwaves everywhere. By mid-March, this geopolitical shockwave caused Brent crude to spike to an incredible $119.50 a barrel. And even after the US-Iran ceasefire happened on April 7th, Brent was still sitting incredibly high at $111 a barrel in late April. So BP's profits are really a direct, unadulterated mathematical reflection of this severe wartime pricing.
And naturally, when prices spike like that and profits soar, political risk closely follows. You brought up the backlash earlier. The crucial point here is how this political pressure actually impacts the bottom line through taxation. In the UK, the government has imposed an energy profits levy, which is essentially a windfall tax set at 38%. Now, when you stack that on top of the existing taxes, it brings the total headline tax rate on UK upstream oil and gas activities to a massive, punishing 78%.
78%? I mean, that sounds like it would completely decimate a balance sheet. How do they survive that?
Well, it would absolutely decimate them if that applied to all their revenue. However, as a smart investor, you really need to understand the structural architecture here. This 78% tax rate only catches earnings generated specifically within the UK. BP's massive global earnings are shielded from these domestic levies. This geographical revenue diversification basically acts as an international tax structure, forming a protective barrier around the vast majority of their revenue stream. They have built a globally diversified fortress to insulate themselves against localized political pressure.
All right, Section 3, the drill down. Cracks and debt.
Shielded fortress or not, I want to shift our focus to find the actual cracks in the armor. It is very, very easy to be blinded by top-line revenue, exceptional trading margins, and global fortresses. But building a structurally sound portfolio requires us to look at the liabilities. Let's see if this company is actually bleeding cash beneath the surface. Because this next number is the one that keeps me up at night. $25.3 billion in net debt. And here's the true kicker for retail investors. That is a highly concerning increase from the $22.2 billion in net debt they held at the end of the fourth quarter of 2025. You simply do not forge a strong portfolio by ignoring a $3 billion debt spike in a single 90-day window. How does a massive company double its profits to $3.2 billion, yet simultaneously see its net debt blow up by over $3 billion in just 3 months? That is a severe crack in the foundation that every single investor needs to scrutinize immediately.
Okay, let me step in here and do the heavy lifting on the data to explain that debt increase, because it actually comes down to a massive $6 billion build in working capital. Now, for the everyday retail investor, what exactly is a working capital build? In our business, it represents a temporary drain on operating cash flow. It basically means cash is tied up in the everyday physical operations of the business rather than sitting safely in the bank. So where did that $6 billion go? Well, $4.1 billion of it is tied up in seasonal effects and much higher inventory costs. Just think about it structurally. Because of the conflict in the Middle East, commercial ships have to take the long way around Africa to avoid the conflict zones. That means shipping routes take weeks longer, and the cost of the raw product on board is higher. That oil sitting on those ships is basically floating cash that BP cannot touch yet. It's locked in transit. Another $1.1 billion is simply the timing of payments, money owed versus money received. Finally, $800 million went to other items, primarily legacy legal settlement payments in the Gulf of America. So the cash absolutely didn't just vanish into thin air. It is structurally locked up in the physical mechanics of a severely disrupted global supply chain.
Okay, I understand the mechanics of floating cash, but not all the damage is just numbers on a spreadsheet or delayed shipping routes. We are talking about physical, destructive damage to real-world assets. BP's Rumaila oil field in southern Iraq was explicitly targeted by drone attacks during the conflict. Right now, the company is literally waiting for shipping restrictions via the Strait of Hormuz to lift just so they can get personnel in and accurately assess it. Do you realize what that means? Waiting for shipping lanes to clear just to look at the damage means this is a massive, completely unquantifiable black cloud hanging over their future earnings reports. The early reports indicate multi-billion-dollar repair bills are highly expected. As an investor trying to build a resilient portfolio, you have to factor in these massive future liabilities. These aren't just temporary working capital drains that will eventually hit the bank. These are hard, unavoidable capital expenditure requirements that will absolutely cap future profits and bleed cash from the core business.
That is a completely fair risk to highlight, but you have to acknowledge that BP's management is fully aware of the debt pressure and the physical risks, and they are actively engineering structural reinforcements to the balance sheet as we speak. Let's look at the strategy. Step 1. They announced the agreed sale of their Gelsenkirchen refinery in Germany to the Klesch Group. This strategically simplifies the portfolio, sheds dead weight, and helps increase their structural cost reduction target to an impressive $6.5 to $7.5 billion by 2027. Step 2, they are directly attacking the debt. Subject to market conditions, they plan to aggressively reduce their perpetual hybrid bond capital by roughly $4.3 billion. Now let's unpack that for a second. What exactly is a hybrid bond? It is a complex financial instrument that acts a bit like debt and a bit like equity, and it often carries very high interest costs. Redeeming $4.3 billion of these euro and sterling bonds without replacing them is exactly like a homeowner aggressively paying off their highest interest credit card balance to structurally strengthen their monthly household budget. By bringing the total hybrid bond stack down to approximately $9 billion, they are demonstrating highly disciplined structural balance sheet management.
Moving to Section 4. The verdict: opportunity or trap.
All right, we've broken down the core profit engine, the macro geopolitical tailwinds, the surging debt pile, and the strategic asset sales. It is time to synthesize all this macro and micro data. Let's cut through the noise and deliver a final, no-nonsense verdict for the people watching.
Exactly. Let's review the structural pros first. The physical assets are performing at absolute peak efficiency, with 96.3% refining availability. That immense operational strength, combined with exceptional global trading optimization, forged a massive $3.2 billion underlying profit. Furthermore, they are actively simplifying the business and paying off expensive hybrid debt to reinforce their long-term financial foundation.
I hear the pros, but I'm going to interrupt you right there, because the cons are incredibly severe. You cannot ignore that the net debt is creeping rapidly in the absolute wrong direction, currently sitting at a heavy $25.3 billion, dragged down by a massive working capital drain. But honestly, more importantly, this entire quarter's success is deeply, fundamentally vulnerable to Middle East price shocks. Their margins are built entirely on a fragile geopolitical environment and violently disrupted shipping lanes.
But listen, those disrupted shipping lanes are exactly what their traders capitalized on to generate that massive return. In this sector, the volatility is the opportunity.
Yeah, until it isn't. Think about it. If peace breaks out and global oil prices suddenly normalize, or if those multi-billion-dollar repair bills at the Rumaila field come due all at once, that massive high-revving profit engine could stall out very quickly, leaving everyday investors holding the bag.
And this brilliantly illustrates the ultimate dilemma for anyone looking at this energy giant right now. The operational data is undeniably strong, but the future macro environment is intensely, predictably volatile.
So, we turn it over to you. Based entirely on the cold, hard facts, the operational metrics, and the geopolitical timelines we've drilled down into today, you have to make the call for your own financial future. Look closely at the balance sheet, weigh the severe geopolitical risks against the undeniable operational efficiency, and ask yourself the tough question. Is BP an ironclad opportunity waiting to be forged into your portfolio, or is it a dangerous geopolitical trap just ready to crack under pressure?
Thank you for joining us on this explainer. Our goal is to provide you with the raw materials. It is up to you to build the portfolio. Keep your risk managed, keep analyzing the source data, and we will see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.